Hello and welcome back to the channel. This is Chapter 2 Part 2 and we will pick up where we left off. Lloyd's Plan. Non-regulated rates offered for a full range of property and casualty insurance, except life. The members of Lloyd's are called underwriters, and the company is administered by an attorney in fact. A Lloyd's company cannot incur a premium to surplus ratio in excess of 10 times its net assets. Originally, Lloyd's were formed by stock companies to escape rate regulation for high-risk insureds. Some Lloyd's now offer insurance to preferred customers, but are prohibited from changing less than the parent company. Lloyd's are 100% backed by the parent companies for surplus and claims requirements. Self-insurers. Some companies choose to self-insure rather than pay premium to an insurance company. They take the risk on themselves, possibly setting aside monies to pay out in the event of losses. Private versus government insurers. Most insurance is covered through private insurers. Some insurance can only be purchased through the federal government. Due to a greater exposure, private insurers do not want to take on those higher risks. For example, flood insurance must be purchased if a house is constructed on a floodplain and in an approved community. Authorized versus unauthorized insurers. Another way of classifying insurance is according to if they are licensed by the state or not licensed by the state. An admitted company is an authorized insurer meeting the minimum requirements of financial strength and licensing. In Texas, admitted also means that the company has a certificate of authority. A company choosing not to come under this type of regulation can still write insurance in the state, but does so as a non-admitted company. Domestic, foreign, or alien. An insurer may also be classified by their place of origin. A domestic insurer is organized under the laws of a particular state where it is housed or domiciled. A foreign insurer is organized under the laws of some other state within the United States. An alien insurer is organized under the laws of another country other than the United States. Lloyd's of London would be considered an alien insurer. Responsibilities to insurer. The agent's duties to the insurer under common law includes liabilities for negligence or breach of contract. An agent has a fiduciary responsibility which requires a higher degree of care. The following are examples of common errors that an agent may be held liable for. Making mistakes. If an agent makes a mistake on the customer's request for insurance, the company will be held liable. The company may have the option to hold the agent responsible for the mistake. Failure to follow company instructions. If the company incurs a loss due to an agent's failure to follow instructions, the agent may be held liable for the loss. Failure to disclose information. An agent has a duty to the company to disclose all pertinent information about the customer to the company. Delay in forwarding information. The agent has the responsibility to forward all information regarding a customer's policy to the company ASAP. Exceeding the express or implied authority given by a company, an agent must understand and comply with the insurance terms granted by the company. Responsibilities to the insured/customer. Under common law, the agent has a duty to the insurer to protect their interest. The following are items that the agent can be reprimanded for in not taking care of the insured. Misrepresenting insurance coverage. An agent may not risk misrepresent coverage provided to the consumer by a policy. Failure to procure insurance. An agent who promises to provide insurance for a customer owes a duty to obtain the coverage for the customer. If the agent has tried and failed to obtain coverage, they also owe a duty to the customer to notify them that they were unable to obtain their requested coverage. Procurement of inadequate coverage. An agent who agrees to procure insurance for a customer must use reasonable care to provide adequate amounts of coverage for the customer's needs. Failure to inform insured of renewal. An agent owes a duty to inform the insured of premiums due for the renewals when the agent receives information pertaining to the expiration date that is intended for the customer. Failure to investigate an insurer's financial solvency. An agent owes a duty to place coverage with a solvent insurer, reasonably monitor the solvency of the insurer. Inform the insured of any significant changes on the insurer's solvency, and to protect the insured if the risk of bankruptcy of the insurer becomes too great. Law of agency. Agents or producers represent an insurance company or insurer and usually hold a contract with that company. Independent usually represents several insurance companies on a commission basis. Captive or exclusive usually represents one insurance company and is usually on commission basis. Direct mail/direct response. Insurance company doesn't use agents. Instead, they sell insurance by mail or internet directly to the consumer. Authority. Express authority, derived from a written or oral contract between the agent and the insurance company. This describes their rights and responsibilities. Implied authority arises out of an agent's express authority. This authority is what the agent assumes based on what he or she has been told. Apparent authority is based on a customer's belief supported by parents that the agent has authority to perform an act for the company. Contracts. The insurance policy is a document that contains the legal contract between the insured and the insurance company. Since we are working with the legal contract, it is important to know the 4 elements of a legal contract. Consideration. Both parties must assume some type of responsibility. In the insurance contract, the insured agrees to pay premium and the insurer agrees to pay for any covered loss. Legal purpose. A legal contract cannot be used for an illegal or immoral purpose. Agreement, offer, and acceptance. When an applicant for insurance submits an application, this is the offer. The insurance company has the right to either accept or deny the offer, which is binding on both parties. Competent parties. The incompetence of either party can void coverage. This can include mental inability to comprehend or if the applicant is a minor. Distinct characteristics of an insurance contract. Contract of adhesion, a term descriptive of a standard form printed contract prepared by one party on a take-it or leave-it basis. Aleatory contract, equal value is not paid by each party. The premium paid does not equal the recovery amount in the event of a loss. Personal contract, the insurer and the policyholder both consider the credit, conduct, and character of the other. Unilateral contract, a contract in which only one party makes an enforceable promise. Conditional contract, in the event of loss, both parties must still perform certain acts to make the contract legally enforceable. Indemnity. This concept is the basis of most insurance contracts. Indemnification is placing the insured back at the same financial position prior to the loss. It is unjust for the insurer to make a profit from insurance. It is also unfair for the insurer not to restore the insured to the same financial position they were prior to the loss. Utmost good faith. Regardless of circumstances, each party in the contract will assume that the other party is acting truthfully or in the utmost good faith. Representations, statements made by the applicant to the insurance company during the process of obtaining a policy. They are important because they allow the insurance company to evaluate the risk. If a representation is untrue, this becomes a misrepresentation. This may allow the insurance company to cancel the policy because of the material representation. Concealment, the failure to disclose a known truth. For an example, an applicant neglects to mention their 16-year-old son who just got his license and will be driving the vehicle. Hiding the truth can have the same consequences as lying. This may also allow the insurer to cancel the policy. Fraud, an intentional perversion of the truth for the purpose of inducing an insurance company to accept an application or pay a claim. Warranties, stipulations, and the insurance contract that, if breached, may void the contract. For instance, a commercial policy may state in the contract that working fire extinguishers are not present. This may void the policy. Waiver and estoppel. Waiver is the relinquishment of a known right. Estoppel is a result of that waiver. This is the end of Chapter 2. I hope that this information will help someone that is interested in getting their Texas adjuster's license. I know when I became interested in claims adjusting, I wanted to know what I could expect and what information is needed for the Texas exam, so I hope it gives you some insight on what you are expected to know. Please don't forget to like, comment, and subscribe. Thank you for watching.